thing I've been thinking about here in San Francisco is this idea of urgency. Like
speed, growth.
Yeah, urgency. But just more looking at, before we get into like the whole market, like just for venture capitalists, like there's this feeling of urgency. You always need to be urgent. Yet we're in a role where we're supposed to be like thinking about the future. And yet you have to, when you're thinking about the future, you also have to make sound decisions like in the now.
Yeah.
And there's this idea that the best predictor of success, whether it's our companies, whether it's our firms, whether it's us as individuals, is momentum. And so I've just really been thinking about like, how do you balance both of those as an investor?
And the two things are urgency and momentum are kind of two sides of the same token.
But I think, or I could just be projecting, I think we think them as like the exact same thing.
Urgency, momentum. I once heard this statement by someone that said, be fast, but don't be in a hurry. And that's what that kind of reminds me of, where we're in venture. Venture calibrates around growth. Venture invests in growth. And behind growth are operators at startups who move with the sense of speed and urgency. And kind of abstracting that back perhaps to venture. And it's a bit palpable on this trip where like people are kind of running around. Like there's kind of sense like you're running around, you might be acting in a hurry, not being quick about something. And I think kind of the difference is when you're in a hurry, you're sloppy.
Yes.
And maybe that's kind of what you're getting at. Like, are we taking the time to actually step back and say, what do all these things mean in front of us? The confluence of trends and factors we're grappling with, and how do we take a position on the future and then invest in that? Whereas right now, are people just you're kind of just doling out the cash, hoping that you strike gold at some point, and that's sloppy.
It makes me think of two things. Anybody who knows me knows or spoken to me. I sometimes speak in cutaway scenes of Family Guy. And, and so one cutaway scene that comes to me is just like talking to a number of friends here in the valleys, sometimes even in New York, that are in venture. It feels like we can all say the same talking points and moving to the next thing. And the cutaway scene that comes to me is just like Scooby-Doo. And you know the bit that they always have when they're being chased by the ghost, and they're just going from room to room to room to room. And it's just like, yeah, there's action there. And at some point, they're actually chasing the ghost themselves.
That's right.
But are you taking the time to think? Are you actually making any progress? And so
motion versus movement.
Exactly. And so that's the thing where, and as at the time of the recording, like 2 weeks ago, the debate on if great men are introspective or not. And it makes me think of like, all right, if there's a 2x2 matrix and it's like introspection on the x-axis and action on the y-axis, you don't want to just be all action.
That's right.
With no introspection. And you definitely just don't want to be introspection with no action. You just ruminate. You're not doing anything.
Yeah.
And so you have to find that balance of like, am I thinking about something? Like, why am I seeing 3 companies that are all doing the exact same thing? Right?
Yeah. And might have very similar growth rates, performance.
What does that mean? Is this a category I want to be in?
And that's being introspective.
Yes. And then the action is like, all right, taking the time to think, talk with your team of like, hey, this is how we're going to approach new categories that, may be very, competitive, all seem promising, but like, how are we going to adjust? And we can't use the same tools that we used in the past and metrics. And so I've just been really thinking about that because I'm seeing a lot of action, seeing a lot of people moving to one term, to the next term, we all love physical AI. Do we know what that means?
Yeah, and is that actually like kind of a new thing? Or yeah, I ran into a buddy of mine who spends more of his life kind of Series A, Series B, but I mean, he was talking to me about his portfolio, and he's like, "Listen, I have two companies. They both are clocking in about 4 or 5x year-over-year growth. They're in market for Series B, or we're in market for Series B. The one did about 60 meetings, got one term sheet. The other did something similar, actually a bit more, probably a bit closer to 70, got no term sheets." And I looked at him, I go, like, how do you parse that? Like what does that mean? Like we need to be rational actors.
Mm-hmm.
And it feels like the broader venture market is not necessarily reflecting that rationality back. And he kind of held his head in his hand. He goes, I don't entirely know. And he also kind of made mention, and we've heard this and talked about this even independent from this particular individual, that it just feels like all the capital is chasing at any given point 10 to 15 deals, and that's it. If it's not those 10 to 15 names, it just ain't happening.
Yeah.
And that's kind of goes partly to what you're saying, as to there's a lot of action. There may not be a whole lot of introspection, just stepping back, breathing a bit and saying, but what is it that we're trying to do? Investors feel like they're unwilling to do what investors are actually paid for, which is holding opinions, and holding opinions that might feel, people use the word contrarian. I don't know if that's exactly what I'm getting at here, but being independent thinkers and making informed investments based off of the work you put in,
mm-hmm.
rather than just being in a modality where you're acting first and then thinking about it later because something bad happens to an investment you made.
Yeah. It's like, a term would, in my like almost 12 years in this business, the idea of like intellectual honesty would always kind of come up in firm building, in conversations about like, what are we doing? And at a certain point, we've just kind of become, like, a long time ago when I started my career, we just become like equity research, where it's like, I would do the numbers, have my opinions and assumptions, and then my boss would be like, can you check SNL, see what the consensus is saying? And in the private market, that's kind of what we're doing right now. And, there's a lot of fear associated with that. And in a career where you're actively trying to predict the future, you need to be an independent thinker. That's what's going to make the team better. That's what's going to make your investment better. And with that, understanding that, like, yeah, it might not work out.
Yeah.
But I believe that it will, right? Like, you have to hold both those things true.
Yeah. Well, and VCs are in this privileged position of, your job is to have opinions and take risk. The LPs that back you understand that not everything's going to work out.
Yeah.
And yeah, that like modulates based on the stage you invest in, but having an opinion and taking risk generally means that you need to have an independent thought. Oftentimes that thought is non-obvious to the masses.
Mm-hmm.
And over time, part of what is embedded in that process is you believe that your off mainstream perspective and action you're taking off that perspective by making an investment becomes mainstream, because that's where kind of returns start to accrue. But that's not going to be the case if everybody's just piling in onto what is deemed to be a consensus view
Yeah.
and a consensus set of investments. And that's going to maybe even even if returns are good, it's going to homogenize returns across a variety of firms because you're all kind of either in the exact same name or the one of kind of three things, at which point then LPs are probably going to step back, or even you yourself as a GP are going to step back and say, so like, what makes this a better investment than this one or this one? And in a lot of these markets, it's not necessarily winner take all. At least not at this point. We can't tell.
Yeah. So I think that's a good point to stop where my question is like, one, why are we doing this? And that's not a meta question. It's just like literally, like, why are we doing a podcast? It's not like you can, we're an anomaly. The first like VCs to do a podcast. It's plenty.
God knows the world probably doesn't need another VC.
We each have our others that we do. So why did you want to embark in this kind of crazy idea to think that you and I could provide something different to the marketplace?
We have this kind of quip at Dynamo that will come up occasionally as to VCs oftentimes won't actually tell you what they think. Like when founders come back and they go, this is what, like, they passed, or this is the feedback, and we'll generally say, okay, like, what did they say, or could you send us the email? And we'll say, like, this is actually not what they mean. Like, VCs as an industry, I think we could do a lot better being much more open and candid than we are. Yeah, this occurs behind closed doors in certain rooms, but there's a lot of value in exposing parts of those conversations and being able to explore in the masses, or like with the masses rather. Like, let's learn and be curious together, but also have that candor as to this is what's happening. And it's okay to say, like, some of this stuff is fucking asinine. Like, we cannot be independent thinkers right now. We're actually not thinking about building durable businesses that can still grow quickly. Instead, we're over-indexing to, right now, really growth at all costs that is creating a bubble.
And we just went through this.
What? It's 2026. We're 3 years removed from a COVID era bubble popping, yet we're willing to enter another one. And is that because venture is about growth, and that's just how growth is manifested? Wherever you are looking for outlier growth, you also are going to end up in kind of bubble-like environments? Maybe, but I don't know if that those things are necessarily always joined at the hip. But kind of going back, like, why are we doing this? Let's explore and be curious in the open. Let's have the candor that we want others to have and express when they think about the craft of venture. And this is about building and improving on this craft together.
Yeah. Great answers. My reasoning was because I feel that, I don't know when we could say knowledge work started. I don't know. Maybe say 1950s. I don't know. But we've had this first kind of era of knowledge work. We really focused on exalting, and rightfully so, experts, right? And exalting those who have spent time in specific industries and in specific studies, and catapulted them to help lead us in different areas, right? And we're still doing that, obviously, and I'm a proponent of that. But in a day and age when we have access to information like never before, knowledge is not in a specific, like, going very, very deep is not an advantage anymore. And maybe it's a result of, like, I don't know, the brainwashing that I had at Columbia with our curriculum of core curriculum, where we just became the most liberal arts school ever and just like try to learn literally everything. Or, recent books that I've read on just the importance of lateral thinking. I do believe in today's time, in a world where things are becoming more and more siloed, more and more, mini bubbles all over the world in different industries, countries, whatever. We need more bridges and more lateral thinking. And so it's a time for the generalists. And generalists can be in all different type of ways, but your ability to like be able to see things from different areas and apply it to your industry, that's when breakthroughs happen. And so for me, people will probably get tired of this over this time, or maybe it'll just be right in their lane. Anybody who's a sports enthusiast, I'm going to talk a lot of sports analogies, but I was fascinated with like how JJ Redick was able to go from like middle school AAU coach of his sons to the Lakers.
Yeah.
And his ability to, showcase his mind, and with like arguably one of the greatest minds in basketball ever, with LeBron, and that Mind of the Game podcast, I was like, that's what's needed in venture, is being able to be able to weave between like showing novice what the technical like aspect of the game is, but then also provide insights to those who are in it and love the craft. And so I'm not saying you're LeBron. I'm definitely saying you're not LeBron today. But I've always appreciated your like seriousness to the craft.
I appreciate that.
And I was like, I've known you when we were both kind of like, when I was starting at Prologis, and your
it's been a decade.
Yeah, your hustle. But then getting to meet you and like getting closer during Kaufman, I was like, man, this guy is really a student of the game. Like he could just stay in his own lane, but he's trying to learn everything within venture from the history, but not be bound by it, and see kind of like where is the like industry going. And so that's when I was like, man, we should do this, and we should, how do we help carry on the industry?
I love that.
Yeah, that was corny, but it kind of worked.
Works.
So that's why I wanted to do this podcast, and I think I'm looking forward to us having conversations, being curious, showing conviction, showing vulnerability on stuff we're actively thinking about.
Yeah.
And hopefully we can push each other and be pushed by the audience as well, of founders, VCs, fund managers, LPs, everybody, just folks interested in the space.
Yeah.
And then we'll have some guests on too, of folks that have done it before, actively figuring it out. And I'm excited about it.
I think this is such a dynamic time in the venture industry where everything is shuffling and resetting beneath our feet.
Yeah.
Back to your point, right? Like I've always believed there's a lot of value kind of looking back, because history, I do strongly believe, rhymes. It'll seldom repeat. But from that, we have a little more of an advantage to figure out what should we be looking for in the present and projecting into the future to understand how to position ourselves, our firms, our companies, the ecosystem.
Yeah.
And not just fall victim to this is currently the game on the field and you just have to play.
Yeah.
That doesn't always end up in a great spot. And I think right now, perhaps we have not seen such a shift in technology. I know a lot of people kind of talk about cloud and mobile as being the last shift, but I'm not sure what we're going through right now. You can really even compare to that. Perhaps kind of personal computing was that last major shift we've seen. That was so profound.
Yeah.
So profound.
So I think a great place to start is like, if you read the headlines, even if you're in the business, outside of the business, you're seeing a contraction of capital going to a certain amount of firms.
Yep.
You're seeing emerging managers having a very difficult time. This is just not everybody, and obviously we know that our industry is about outliers, but like not everybody, but in general, like having a tougher time than peak kind of 2021, 2022. IPO markets, although with some kind of current like optimism, which I actually believe in as well, but really focus being on just a few names who are going to have historic IPOs is what's expected. And the founding of the landscape for founders in being able to raise in graduation rates. Like as a Series A investors, seeing and talking to a lot of my seed and pre-seed folks like yourself, graduation rates now from seed to Series A's, I believe the stat I saw was like 17% or something like that.
Yep.
When I think about when I was first starting in 2015, it was probably double, if not
It's probably close
triple.
to half.
like of it. So of that figure. So you got all that going on. We got macro events that are serious events, geopolitical shifts, and on top of all of that, the labor market is drastically changing or brace for a change because we have the technological shift that's unlike any other. So how do you take in all that when somebody asks you, both a novice, you're in a group of three, you a novice to the industry, as well as somebody who is in it, like what do you say?
Oh man.
You say we're fucked? Like what do you say?
So we haven't seen concentration. If we take a step back, right? We're talking about an ecosystem of investors that invest into what they believe to be the technology-driven category leaders 15 years from the point of first investment.
Yeah.
I think the latest data says that it takes from first investment to ultimately harvesting a return in a massive outlier business about 13 to 14 years. So let's kind of call it 15. And behind this is growth. Ultimately, I think Paul Graham is famous for saying, like, you can actually simplify startups. Startups equals growth. And then as I've kind of been in the business for the last decade, I'll equally tell kind of new associates that come into our firm or the industry, abstract that to venture equals growth. Because if venture equals startups, right, venture equals growth. And so where we are today is a situation where you have a handful of firms that have accumulated and bloated their fund sizes, and maybe there's a overly negative connotation to the word bloating a fund size, but they've grown their AUM to such a degree where they have attracted and amassed the vast majority of venture dollars being invested in the ecosystem. And that has created a lot of interesting impact where when you are investing from $1 billion, $2 billion type platform, you can no longer just be the, hey, I'm the series A, B, C firm, or I'm the late stage growth firm. A lot of these firms are just pushing their way down into an area that was for a long time, and I still truly believe is much more of a craft and a boutique business, being able to get from an idea to product market fit, being Series A ready. That's really messy. It requires a lot of time, effort, energy. It can be highly emotional as well. But these firms now, as a result of capital scale, are pushing down and taking option checks at this stage.
Yeah.
And behind that are kind of a lot of incentives we can kind of unravel. But I pulled up some data, Earnest, where when we look at the AI share of funding, 65% of deals last year went to AI related companies.
Yeah.
2/3 of investments just went to AI. A third went to everything else. Like, what does that mean? Like, that is then concentration of another level. There's concentration at every level in the venture ecosystem and capital stack. And how is that going to unfold? How do you compete and operate and build new firms or allow your firm to endure, that's something that's being actively figured out. And you know what? There are going to be a lot of firms that we probably have grown accustomed to knowing, have befriended, have worked with for the last decade plus, and probably view to be stalwarts of venture that may or may not be around 10 years from now.
Yeah.
If this continues.
Yeah.
And now, a word from our sponsor.
We have the pleasure today of having Abe Othman on. And Abe leads a lot of the efforts around research and data at AngelList. And so we're going to dig into some really interesting topics today. Thanks for being on, Abe.
Thank you for having me.
Yeah. So you recently published the Fund Benchmarks report. I was curious from that report, which is I advise everybody to go dig into. What's the headline or finding that surprised you the most? We want to start off with that.
Yeah, across the board, I think we found like just tremendous diversity in terms of the practices of emerging GPs and their venture funds. The single most surprising finding in the data was actually looking at what happens between Fund 1 and Fund 2 and Fund 3 from an LP composition standpoint. So in particular, people have a sense of like, okay, if a manager is successful and certainly successful enough to raise a successor fund, that successor fund will be larger. Yeah. Absolutely, we found that in our data. What we found was that a Fund 2 is typically 2.6 times larger than Fund 1, and a Fund 3 is 2 times larger than a Fund 2. Okay, that's kind of well known. People understand that. I think the most surprising piece is where does that larger fund come from? And in fact, what we found is that I think there may have been a conventional view that what you do is you get a set of LPs for your first fund. You make the money, you're successful, land and expand. You'll get a bigger commitment from them for a second fund. What we actually found was that even though the size of the typical Fund 2 is more than 2.5 times larger than Fund 1, the LP commitments from LPs in the first fund actually decreased. So if you raise $10 million for your first fund, you may only get $8 or $9 million from those people for your second fund. So it's actually net new growth from new LPs that's powering increased fund size, not land and expand from existing LPs. And that holds both Fund 1 to Fund 2 and Fund 2 to Fund 3. So that was frankly shocking to me. I did not expect to see that. So that was the single most, I again encourage everyone to read the report. There's a tremendous amount of findings, but to be frank, like a lot of the findings are that there's a huge amount of diversity among what happens when in small funds, right? Some funds only have 2 LPs, some funds have more than 150 LPs, but the single most surprising thing is that funds expand not by increasing commitments from existing LPs, but rather by finding new LPs to put money in.
That's surprising, but it also makes a lot of sense, especially if you're starting out with more smaller LPs who they don't have a regular emerging manager program, and so it just speaks to how we even speak to our founders of like, hey, you kind of never stop fundraising, and so as emerging managers, even especially when you're successful, you're going to continue to fundraise and try to find net new relationships. That's fascinating.
You always need to have a latent pool of people that want to invest in your next fund, right? Yeah. As opposed to ever sort of sitting and being like, oh no, I have my LP base, I'm doing fine. Yeah, that was surprising.
Yeah, and looking through the research, there's also great data around vintage years, and in my time and talking to a lot of LPs and being in this business as a GP myself, I've always heard, don't try to time the market. You need to be essentially in every vintage. What's driving, from the report 2021 through 2023, those funds look really different from what came before. What was driving that? And what does that mean for fund managers?
has. So 2021 vintage year in particular, I think, has a very good chance of being the first vintage year in venture capital since year 2000 for the median venture fund to lose money. I think there was, there's sort of been a trope that people talk about as like, oh, the median venture fund loses money. Like, that's just not true, or it hasn't been true since the year 2000. Now, obviously, not losing money is a very, very low bar for venture funds, right? Because it's the opportunity cost of locking, the illiquidity involved in investing in a venture fund means that you should have pretty decent returns. Simply returning 1.01x at the end of 10 years is not, that you shouldn't get credit for that because you didn't lose money.
You're not going to get a gold star for that. Yeah.
So it is quite remarkable then for a venture fund to actually, like for a typical venture fund to actually lose money. And, but I think 2021, I would put it at probably 50-50 about whether that's going to happen or not. And I think that vintage year is really slammed. It's, so hard, right? Because you have all this flood of money, like kind of pandemic, money printing that came into the sector. And then at the same time, you have what you didn't see in 2020, like the future from 2021 that you could not predict, which is the rise of AI and ChatGPT. Like that was the other thing that was slamming. Like, so there's a negative thing from the past and also a negative thing from the future. And I think what you have is a lot of 2021, 2022 startups that just, they're not able to raise follow-on capital because they, in some sense, they sort of misspent a bloated seed round, because now there are even if there was a business behind what they were doing, you're going to have a new competitor that's doing the same thing with AI. And so you sort of misinvested that seed round. And so I think it's going to be absolutely brutal for the 2021 vintage year. The thing that jumps out at me about 2021 in particular is, I heard someone say, well, maybe it was just that you had a bunch of, especially I think AngelList as a whole has sort of still, unfortunately, a sort of a legacy reputation as essentially, if not, obviously it's not crowdfunding, but like crowdfunding adjacent, or like, oh, it's not like a real serious place or whatever. And this was like, well, maybe what happened was in 2021, you just had a bunch of bad managers that came on the platform that really shouldn't have run a venture fund in the first place or whatever. I'm like, that's definitely not what the data suggests, right? It doesn't suggest that there's this, sure, the median fund might lose money, but if you had just stuck with the 30% of like core good GPs on AngelList, you would have done just fine. Absolutely not, right? I think the most shocking thing from our data about 2021 vintage year is that the top decile fund is a 14% IRR. It's top decile, right? So it's not like there's this pool of excellently performing funds and just this, a bunch of funds that should never have been created in the first place. It's like across the board, the numbers are not very good for that vintage year. And so that I think is the most provocative thing that we really found from our data about the 2021 vintage year. So I think there's going to be, I think it's going to be a very, whether or not the median fund ends up being slightly above 1.0x or slightly below 1.0x, I think it is something where, you sort of had the worst venture vintage year in 25 years that we observed. And I think it was those two factors, right? Way too much money coming in, like way too much hot money, plus, impending huge technological disruption that no one expected. That's a killer.
And now, back to the show.
The thread that from your comments that kind of resonated with me was things being actively figured out. And part of me kind of questions like, is it being actively figured out, or is it kind of the easy road traveled, or path of least resistance, right? If you're a single investor in a partnership and you pitch a highly contested, meaning like a lot of competition of your peer set are going after this deal that's an AI deal, nobody's going to question why you're doing that deal.
Yeah.
Or looking to do that deal. There's a lot of confirmation bias. And so is that actually kind of doing the work and actively figuring it out or is that just moving along with the tide of concentration? And that makes me think the other thing I'm trying to connect the dots to is like this movement of kind of like, it's kind of like a movement away from the craft towards kind of using capital as a advantage, right?
Yeah.
And so are you losing something in the craft? Because I would argue actually that the craft of venture, if you focus on a specific round or stage and I don't think we can kind of use the kind of like, what do the letters mean at this point?
They're meaningless.
It's kind of like, and I've written about this before, but it's kind of like if you talk to somebody about what are the positions of basketball, like what actually is a point guard anymore?
Yeah.
And so it's now more of like, it's not point guard, shooting guard, blah, 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 to center. It's now just like, all right, ball handler, wing, and big man. That's literally all there is.
Yeah.
And so but I do think if you focus on those, like Inception, so Inception was kind of like pre-seed and seed to kind of like, I don't know, early growth, A and B to like whatever pathway to IPO, super growth. I do think there's a craft in figuring out because we're at a point now where your ability to stock pick is so important because we're not in an industry anymore where you can have real information arbitrage. I say probably past pre-seed. On like this idea of like proprietary deal flow, I'm really questioning like, what does that mean?
I never truly knew what proprietary deal flow actually meant. So you'll find that you probably can't find me ever saying and doing it because I just didn't really know what it meant outside of people.
I hope people don't like clip up you.
But
saying proprietary deal flow.
But like, I mean, like what exactly is it? Because even like 10 years ago, you don't need to go back 10 years, like 5 years ago, it was probably in a lot of pitches. This is why we win. This is why we're great. Are you telling me though, as a firm, you're the only person or group that knew about a particular team working on something, getting ready to go raise? That's like such a minority. The only place that I could like grok it and understand it and agree with it is if you were like effectively a studio model or an incubation shop.
Yeah.
Where that like is truly proprietary because you went in, you put in the work, you convinced some amazing talented people who may or may not have already been interested in this area to come join the journey, and you capitalized them and enabled them with something even beyond capital to go on the journey. And I think like going back to kind of statement of like, is everybody a generalist depending on the vector? The one area that I would push on is there is a lot of nuance. And I think when people are talking about AI businesses actually being built and delivering value for customers, the rise of the FDE has emerged once again. And what that shows is like the importance of context and understanding the actual situation and the nuance of a sector and the workflows. And that's where I do think there's a balance of being a specialist, but I'm also talking my book a little bit as a specialist and industry-oriented investor. But that's where we're seeing things break down, that kind of the generalist playbook doesn't always work when you build businesses. How does that apply to building venture firms? And kind of going back to, I think, what your original statement is, are we actually trying to figure this out, or are we allowing ourselves to be swept with the wave that has showed up? I think behind closed doors, people are trying to figure out, what does this mean? But in the same vein, I need to be seen as doing something and in market and investing, because for one, my LPs are paying me management fees, or I'm taking management fees from my LPs.
Yeah.
I need to show something for it.
Yeah.
But I believe that I can simultaneously continue to invest while figuring out what do I need to do for my firm on a more strategic basis in order to endure and set up for success.
Yeah.
I don't know if those things are necessarily mutually exclusive. And maybe the irony is the larger you are, the more ability you have to do both at the same time.
Yeah. I want to think about kind of where we are in eras, right? Not that all you Swifties out there, eras. I know you can take a shot if you're playing the Taylor Swift game with Carry On. But anyway, and so I've always tried to like think about like where are we in the venture market today and what era are we in? And so if you think about kind of like, you know, the very beginning and the 60s and 70s, very boutique, artisanal, not that many GPs.
Handful of firms. Mostly here.
Mostly
Boston
here.
a bit.
Boston. Yeah, mostly Boston in here. And very collaborative. A lot, hear those stories of famous companies being able to go to all the different ones, firms, and saying, hey, we'll do it if, you know, we do it with these guys. And a lot of kind of like collaboration. Then if we fast forward, we start to see kind of like early days of the specialists in the kind of 1990s. I remember reading one book, and we'll make sure if we say something wrong that we just call ourselves out and they'll have something below us in production. But I remember reading one book of saying like the 1990s, we started to see specialists like Accel started as a telecom fund, focus fund. And so as we moved on there, got past the .com era, we started to see kind of like this idea of how do we provide more value? And that's when you start to see Andreessen come up in the late aughts, early teens, and kind of the CAA model. Then I felt we had like a mini era of like, how do we use data as a marketing tool? And so we provide data, and there's a number of firms who've done that. Then we moved on to, I think, the stage that we're in kind of like right now is this idea of branding and each firm becoming their own kind of like mini or huge kind of media company. And what we're trying to do is very similar to what we ask of portfolio companies, especially in the consumer space, is how many eyeballs do you have? Like, how much time are people spending on your app? How much like time, mind share, literal mind share of people do you have? And so that's kind of setting the stage, kind of like all these places. Where do you see us kind of at today? And is there anything we can kind of pull from all the things? Because I know when we spoke earlier, you were talking about kind of this idea of like a pendulum swing and kind of like, with the new ages of emerging in managers and now the consolidation of capital.
And both of us kind of came through a finance matriculation. But Howard Marks is one of kind of the greatest cross-asset investors to ever operate, founder of a firm called Oaktree. And Howard Marks has this concept in any asset class where you invest of the pendulum. And the pendulum is always swinging between two massive extremes. And the thing that he always thinks about as he goes from credit to equity to private equity is where's the pendulum relative to where it should be? The pendulum seldom is in the middle, but is it on one side? What action do I take? Do I short a position? If the pendulum is kind of long on the other side, is there a lot of value, and should I go long a position? And that doesn't quite fully map to venture like for like, because you can't really hold a bearish position on a company. I guess a bearish position is not investing.
Yeah.
But as I kind of think about this, is I think venture has always kind of gone back and forth in terms of like a fund level between having fewer firms and many firms. And if we kind of go back, let's go back to the mid 2000s. I think 2004 is when First Rounds raised its first fund. That was around kind of the Cambrian explosion of, hey, we can have this thing called the seed manager. And they tend to come in at that inception formative stage of a company and get you to a point of product market fit and the ability to scale, which is what the A and B investors are good at. And kind of on the back of that, as you kind of cross 2010 into the kind of mid part of the 2010s, you had this like Cambrian explosion of seed managers. And we've kind of had that up until probably 2023, 2024. It was just a really fucking good run, right? But like if you sat at some of those older franchises who at that point still, relatively speaking, had raised quite notable fund sizes, what were you thinking here? You probably were like, hey, like, what does this mean for me?
Yeah.
Where do I sit in this regard? But it was probably a bit easier to grok because there were just fewer firms still. There's a much clearer, this is what we're doing as the new kids on the block. This is what we think you do as the more established players around. And there was a bit more of a division of labor, kind of pulling from the types of things I like to invest in at Dynamo. But there was a pendulum swing there, right? You had kind of concentration, and you had kind of an unbundling almost of investing across stages. Rather than one firm willing to go from inception all the way to pre-IPO, there was now a kind of unbundling of stage. There then toward the late 2010s, we were established in 2016, there's even an unbundling of industry competency as well.
Yeah.
And you even saw functional competency. You had kind of the firms that are really good at sales and sales enablement, the more technical firms that ended up coming on the scene. And I think where the pendulum's shifting now is we're just in a massive world of aggregation of capital. And even maybe the reaggregation of stage and sector competency. The question now is, does that work? We've for 10 years been in a place where all these things were unbundled. I think Jim Barksdale said, there's two ways to make money. You bundle or you unbundle. And venture is still a business. People may not treat it like that, but the way I built my firm is I treat it like a startup. If something isn't working, I shoot it in the head, enable my team to go figure out how to fix it, because I don't have all the answers. But let me tell you how concentrated the capital is now, because I ran some numbers. And funds larger than $500 million have raised nearly 70% of the capital raised to date in the last year.
That's crazy. Wow.
So like pendulum swing. And that's where we are right now. Where are we going to go? I'm not entirely sure, but as I kind of reflect on the past and what we know about venture, the most mind-numbing thing and frustrating thing as a venture manager is how long the feedback loops are. You'll know when things don't work relatively quickly. You'll know that generally as early as maybe 18 months, depending on what a portfolio company is doing and how they've been capitalized. But you don't really know whether you've really won and whether the reasons you made an investment that has allowed you to win are valid for as long as 15 years. And I think there's some relationship with the pendulum swinging, because a pendulum swing takes time.
Mm-hmm.
That works in relationship with the feedback loops of venture.
Yeah.
Private credit, 5-year, right? Public markets, within a year sometimes, depending on how the market waxes and wanes. We don't have that benefit, but that does not mean the concept of the pendulum, in my opinion, is invalid.
Yeah. You bring up some great points. My thought is that it's like, how do you anticipate where it's not even because I think trying to anticipate where the pendulum and how it will swing is something that is like, oh, how do I predict a lagging indicator? Right. Mm-hmm. You want to be able to see what's actually going on. And specifically where my mind goes is like where, just like a new type of technology like AI or something else, but like, what are the new industries? What are the gaps? What are the problems that are going to be created through this technological shift? And if I apply that to then the pendulum swings of venture, it's like, what gaps are going to be created that are needed to have an efficient, vibrant, early stage, mid stage, growth stage ecosystem?
Yeah.
And so I think too many times we react as an industry to lagging indicators.
Yeah.
And whether that's, we're all up and to the right. We got IPOs of companies that were started in 2015 or earlier. Ventures back. People are rich. Let's invest in more. And we kind of forget that like it takes time.
Yeah.
And so for me, where I kind of anticipate is like, all right, it seems like the feedback that we are instituting in the ecosystem right now is that graduation rates are very low. So we're determining, in as your terminology, not mine, shooting. He was talking about ideas, guys, not people. Shooting ideas in the head earlier of like, this will work, this won't work.
Yeah.
So that's a byproduct of kind of like where things are going. Another byproduct is this idea of king makers. And regardless if that's true or not, like this idea of like, if certain firms invest in a certain category, you're SOL for shit out of luck. If you're invested in the other competitors.
Does it have to do with the firm, you think? Or the amount of money? Maybe those two things are tied at the hip because so few firms have raised so much of the capital.
Yeah.
But do you think like the brand of the firm is what matters, or just the fact that they parked a ton of money into a player in a particular sector?
I think it's like most things, nuance. I think there are certain firms with a lot of money that pack a stronger punch than other firms with a lot of money.
Okay.
Right? I think there's degrees to
how credible that king-making tactic is.
Credible. The signal that comes along with that capital that can lead to more capital. It's not just that specific firm has capital. Do they have like standing with the overall like?
Are there a bunch of lemmings willing to jump off the cliff?
I wasn't going to use those terms because
I will. But I mean, that's kind of, I think, representative of where we are as a market.
Yeah, and so I think I think it's a combination of both. And so for you, if we have just two types of like in the framework that I was using is, like I said, it's been truncated now from like your pre-seed, seed, series A, B, C, D, E, F, G, elemental P.
Yeah.
It's been truncated to now like we have inception stage. I misspoke earlier, but it's traction stage and then growth stage. Mm-hmm. Like if they're now just like that, even goes smaller to just like super early inception, and then we do everything else.
Yeah,
we're the Amazon of of it. Like, how does that impact your job as a seed investor?
I think if you talk to most seed investors who have been relatively disciplined in terms of fund size, how they think about portfolio construction, where they truly believe that they have credibility to invest with an advantage, and an advantage could manifest itself in a number of ways. I think the big question that is being asked, there's probably a couple questions, but the big one is this time actually different? And what I mean by that is going back to so much capital has gone into these mega firms with mega fund sizes. They are now pushing down oftentimes out of necessity, but also kind of flexing their muscle in terms of we can be more thoughtful and strategic, where if we come downstream, we can start to hoover up a bit of ownership. When things look like they're working, we can start piling capital in, because the way you do kind of deliver outsized returns is high ownership. So capital concentration is a function of that. But because they're coming downstream, they have a relative insensitivity on price or valuation. And the historic kind of perspective had been, we are going to be disciplined around valuation, because valuation is actually an output of ownership that you need.
Yes.
And so what is our what is our future? If this time is different and this is how the world is going to endure, what happens to us? Like, does our next fund size need to be 3, 4, 5x what it is now? Are our LPs going to buy that? How does that change our underwriting? Can we compete even at that kind of level in terms of kind of larger fund size? Because then we're starting to maybe run into some of these guys more head on.
Mm-hmm.
Can we compete if we're going head to head? Does our value prop still hold? And if not, like, does that mean we're just out of business?
Yeah.
And is there like a pending mass extinction event, going back to my prior statement? There are going to be a lot of firms you and I know, respect, admire, have been around forever, that may not be around at the end of the decade because of this. But that's conditioned on this time actually being different. And there is this mega concentration and it's working. And the reason it would be working and validated is we're sitting in a year where there are not 1, but 3 mega IPOs anticipated that are going to return massive sums of capital to the mega funds: SpaceX, OpenAI, Anthropic. And it may not even need to be in calendar year 26. This is like, hey, this happens in the next 18 months. These mega funds feel validated. Their LPs feel validated. The party goes on for them, but not for the rest of us.
Yeah.
Fuck.
Exactly. So why? So what needs to be done differently? How can it be different? It can't be us all, and this is all small, medium-sized, large funds. We can't all have the same deck creator, right?
You technically can with the right cloud skill.
We can't all say the same thing.
Mm-mm.
And we have to be willing to be differentiated. And so
I guess the question is, what does differentiation mean in this era with these mega funds? And does that differentiation land on the founder, who's the customer?
Yeah, it's going to, I think I'm always going to be biased. I'm building a firm towards this where I think it's going to be a human answer to it. And I always go back to this on one of my favorite scenes in American Psycho. Don't judge me. But
favorite scenes in American Psycho
is I love to do the verbal ellipsis so people can be like, what are you going to say here? But one of my favorite scenes is when Christian Bale is riding in the taxi with Reese Witherspoon, and she's like, why are you even working at this job, like, and stressing about it? Like, you can just work for my dad. And first of all, he's ignoring her. He has his headphones on. He takes them off and he's like, I just want to fit in. And we have to break that in an industry where we're expected to find exceptions. We need to be exceptions ourselves. We need to, like, all these things, like the SaaS era really left us in a period of just like playbooks and expectations. And whether it was a enterprise customer or consumer, we treated the subscription product type like, oh, everyone can go to Target and find the SKU that they want. Turn it on and we're good. TAM can be this, and we'll expect. And And so you created these playbooks that had a certain level of comfort and security. We live in a world where there's no security.
Yeah.
We always
Technically did.
have. And so what we ask from founders today is people who can be resilient, be very quick learners. This idea of learning velocity.
Yep.
Understand what's going on, testing things out. What did we learn from that? How do we move forward? What is competition doing? Staying extremely close now that we're moving from not totally away from software, but a combination of software and services and automation means you have to stay as close to your customer as possible. And so all those things we're expecting from our founders, picking the right partners, whether that's strategic partners, whether that's capital partners, we got to start expecting that from ourselves too.